HIMS and Hers Health, a stock that a lot of people have wanted me to talk about. I've seen it in my comments section. I've gotten DMs on Instagram. I've gotten questions about it on my Patreon. Tons of people want to know my opinion on HIMS and Hers Health. You've probably seen these commercials if you watch any amount of TV or YouTube or whatever, but they basically sell pharmaceutical drugs through a telehealth model that can handle weight loss, hair loss, sexual health, mental health, skincare, and they also sell supplements that help you address these things as well. They're doing a great job building out a moat for themselves, specifically in the sexual health, mental health, and hair loss categories. It's very, very impressive, and their ads are really sleek. The whole idea is that you can get drugs that work to address the problems that you're dealing with literally from your home through a telehealth call and a package sent to your door. It's a beautiful model, and I think it makes their customers feel really empowered that they can handle these things basically all by themselves from their phone or from their computer. But putting all that aside, what you're here for is to hear about HIMS and Hers stock. So let's talk about the stock. We're going to dive into it, whether or not I think it's a buy right now, and whether or not I think it's a great opportunity, terrible opportunity, etc. We're going to get into all that. But first, if you're new here, I'm Austin. I'm co-owner of cloudbusinessweekly.com. I'm also a stock market investor, okay? If you're new to the channel and you're not subscribed already, become one of those 2,400 or so people. It would mean a lot to me, and consider checking out the Patreon with the pinned comment down there in the description. As a thank you for doing all that and clicking that like button, here's a picture of my beautiful dog, Penny. All right, hope you enjoyed that. Let's get into it. So HIMS stock is sitting at $8.25 right now with a market cap of $1.7 billion. So let's look at some valuation metrics to get our head around what we're about to dive into. They've got an enterprise value of $1.53 billion. Already right away, seeing the enterprise value lower than the market cap is a good thing. This lets me know that the balance sheet's probably in a really good spot, but we'll go ahead and check that out later. Forward PE of 37.17 with a trailing PE of indeterminable because this stock is unprofitable right now. But that forward PE of 37 is pretty high, but it's not ridiculous whenever we check out the revenue growth rates that we'll see in just a little bit, okay? Price to sales ratio of 2.16. There's a competitor of HIMS and Hers, which has way less revenue growth. Actually, in fact, their revenues are shrinking, that has a price to sales of 3.3, and that company is GoodRx Holdings. So if you've heard of GoodRx, they're also a telehealth company. They definitely don't do the exact same things as HIMS and Hers, but it's very interesting to see that they have a considerably higher price to sales with actually shrinking revenues. We'll get to the revenues for HIMS and Hers in a little bit. So as it relates to net income and earnings per share as a result, HIMS and Hers is getting in a pretty good spot. They're really close to turning that profitability corner. Q4 2022, they beat. Q1 2023, they beat. Q2 of 2023, they beat. And then actually Q3 of 2023, they missed EPS numbers by 1 cent per share, having their net loss accelerate from Q2 to Q3, which wasn't a great look. But the current quarter estimate is negative 2 cents per share. So they're still inching closer and closer and closer to turning that profitability corner. And typically when the stock turns a profitability corner, they get a lot of respect from the market because it opens up a new shareholder base. Tons of people, tons of funds will never, ever touch an unprofitable company. So once HIMS is able to flip to profits, it'll unlock a new shareholder base and probably put a lot of buying pressure on the stock. Look at Palantir stock. Over the past year, up over 200%. They have just started to turn that profitability corner over the last 4 quarters. Stock has gotten an insane amount of respect. Same with Upwork stock. Upwork has only had 2 quarters of profits now that they've flipped to profitability, but they're still up 70% this year. Absolutely ridiculous. I'm not saying the exact same thing's going to happen with HIMS, but typically a stock that goes from money loser to money gainer and can hold that on a quarterly basis, they get a lot of respect from the market. So the operating income is improving every single quarter, but it is still negative at negative $8 million in the most recent quarter, but that's down from negative $19 million in the year ago quarter, actually closer to negative $20 million in the year ago quarter. So they're making improvements in the operating income, and that's mostly coming from the marketing expense rising slower than the revenue is rising. Check out the revenue numbers on a year-over-year basis. From Q3 of 2023, revenue of $226.7 million, up 57% year over year. That is crazy. And when I wanted to check out the year over year rise in the marketing expense, selling and marketing expense was up to $116 million, up from $78 million. So that's in the high 40%, about 47% increase in the selling and marketing expense category. Yes, that's a massive rise, 47% in selling and marketing. But when you have revenues increasing 57%, those margin numbers are going to be better and better and better if they can keep that trend going all the way until they reach operating profitability and, of course, net income profitability. And since we're talking about profits, let's talk about gross profit for a sec. Gross profit on a year-over-year basis in the most recent quarter was up 63.65%. Just doing a little math, we get 63.6% increase on a year-over-year basis. That's compared to the 57% increase. So the core business, the core operations are becoming more profitable as well. This is a product of scale and the unit economics improving. As long as the management team keeps on executing, keeping the expenses lower than the revenue is rising. If they keep that revenue around 50 or 40% and the expenses are rising around 20 or 30%, this company's going to flip to profits and be a profit beast in no time. The gross margin is very, very impressive, and they've had a 4% improvement in gross margin on a year-over-year basis all the way up to 83%. That's a very impressive gross margin. That's in line with some of your favorite companies, maybe like Salesforce and Palantir and some of the other popular names that are in the software space. And I can't say this for every stock. I do see a clear path forward for profitability with this company here. So that is huge. In order for me to be a potential buyer of an unprofitable company, I need to see a very clear path forward to profitability. And I do see that clear path forward with HIMS stock. Let's move over to the balance sheet. We saw earlier that the enterprise value was lower than the market cap. We like to see that a lot. That lets us know right away that the balance sheet is in a great spot. So let's check out that balance sheet. Current assets right now, $250 million. $212 million of that is cash and cash equivalents, with $58 million of that being cash, and then $154 million being short-term investments. Those are investments that could be converted to cash within a 1-year span. Non-current assets of $163 million, with $32 million of that being property, plant, and equipment, and then $130 million being all intangible assets, so we won't even look at those right now. Let's move to the liabilities. Total liabilities, $85 million. When we look at just the cash, $57, almost $58 million, we could cover almost all of that total liability today if they wanted to. And then when you take the short-term investments into account, that could be converted to cash within a 1-year span, $154 million for a total of $212 when you add those up. Wow, the coverage ratio is very, very, very impressive, okay? 212 of cash and short-term investments versus 85 million, not of current liabilities, of total liabilities. Very, very impressive balance sheet. When we look at current liabilities, $82 million, $69 million of that is payables and accrued expenses. Current debt and capital lease obligation. There is no debt on the books. All it is current capital lease obligation, which is just rent, remember, $1.9 million. Current deferred liabilities, which is just deferred revenue, $4.3 million. And then other current liabilities, $6 million. They could easily pay off all of that today in the snap of the fingers, okay? Going down to long-term liabilities, $2.7 million, and all of that is long-term lease obligations. There's no long-term debt on the books whatsoever at all. For an 83% gross margin company that's about to flip the profitability corner, it is already EBITDA positive. That's so impressive. This company's in a really, really good spot. I would say the chances of them going bankrupt are near zero, especially within a 1, 2, 3 year span. If the company turns south for whatever reason, sure, maybe. But in the short term, I'd say there's a near 0% chance of them going bankrupt. They're in a well-capitalized position with dang near no debt. And that's all while revenues are rising in the 50% range. Everything's looking really good so far. So let's talk about one thing that's somewhat troubling, okay? This is from analyst numbers. And if you know anything about me and you've watched the channel a lot, I don't love analysts. I don't think they get it right oftentimes. And I think with hyper growth companies like HIMS and HERS Health, like we're talking about, they're even less likely to get it right. But based on estimates from analysts, this is 8 analysts that cover the stock, they're still not expected to be profitable next year in 2024. So if they're not profitable next year, when's going to be their first profitable quarter? Maybe they have their first profitable quarter in the back half of 2024, but if it's going to take them multiple quarters of -2 cents, -1 cent, -1 cent, etc., to just almost hit that profitability turnaround, that's just going to extend the time before Wall Street and many investors start to give respect to this company. So I'd like to see them get to profitability ASAP, maybe Q2 or Q3 of 2024. I wouldn't want to wait until Q4 of 2024, Q1 of 2025 to be profitable with HIMS. I think this stock would be very much range-bound, kind of dead money if that happens to play out. Another thing here, this year, the analyst expectations are for 65% revenue growth. Next year, analyst expectations are for 27% revenue growth. That is a major drop-off. Is 27% absolute trash? No, that's still super insane. Very, very, very high, extremely respectable revenue growth. But when you go from 65 or 66% revenue growth one year and the very next year you're all the way down to 27%, when a story goes from absolutely insane revenue growth down to really good revenue growth, normally a little bit of disrespect on the name. Is it warranted? No. Does it mean that the growth story is dead with that company whenever they drop to the mid-20s on the revenue growth side? No. And don't forget, HIMS and HERS has a history of beating numbers. So maybe analysts are right about right now, and 27% is what it's looking like. But as we go through these raises and raises and raises as it relates to the guidance, it might end up being like mid-30s or something like that for HIMS and HERS. That's still half of the revenue growth rate. But let's be honest, they can't stay in the 60% revenue growth rate forever. So I don't think it's that big of a deal, but I do think it could put some weakness on the stock price, especially if they come in and miss some revenue numbers. Since the main part of their story is a revenue growth story right now and they're not profitable, any numbers that don't look amazing on the revenue growth side might cause a little bit of short-term price depression. Last thing that's noteworthy that I didn't really talk about was that they actually authorized a $50 million share repurchase program. That's not a lot, okay? The market cap is $1.73 billion, so it's really not going to move the stock price much. It's not going to reward shareholders in a major way. I would rather they just keep that $50 million and invest back into the business. Worry about share repurchases after you've hit profitability. And I'm not talking EBITDA profitability. I'm talking about net income profitability and, even more importantly, operating income profitability. I don't like the share repurchase program right now. It's not the time. You don't need to be rewarding shareholders in that way, in my opinion. Some people think it's great. Some people think it's a tease of what's to come, because shareholders really can be rewarded in a very nice way through share repurchases. But to me, it's not the time right now. That's not the story that they need to have right now. That's not how I want them to reward shareholders right now. How I want them to reward shareholders right now is to use that money to reinvest back into the business and get to operating income profitability, net income profitability. That's what I would rather them focus on right now. So based on their future runway of growth, the moat they've built for themselves, the very attractive price to sales of 2.16, the 83% gross margin, the fact that they're about to flip to profitability, the fact that they already had EBITDA profitability, the crazy revenue growth they have, the expense management that is below the revenue growth numbers so far, and the really, really good balance sheet, I would say this stock is looking pretty dang attractive. I don't own any shares right now, but I've been digging on this company since I've gotten so many comments on my YouTube videos and my Patreon, and I've been digging and I'm thinking about opening a position. I'll keep you updated. I'll let you know if I do buy shares, but I might become a buyer in December of 2023 and then in Q1 of 2024. I still got to do a little bit more research, and I've got to make sure that this fits my risk appetite for my entire portfolio. I already have two stocks that are unprofitable. I have the Honest Company and I have SoFi, which are both unprofitable. I actually own a few shares of Upstart, but I bought that when it went IPO a long time ago. I don't even look at it much, but they are technically unprofitable. So I already own some unprofitable stocks in my portfolio. Do I need more exposure to unprofitable stocks that are probably going to turn that profitability corner? I don't know yet. I'm going to think a little bit more about it. I'm going to sit with it. If it does fit my risk appetite, I will be buying HIMS and HERS stock. I don't know what percentage allocation yet, but I'll say this, it's looking pretty dang attractive. I'll keep you guys updated. I want to know what you're doing out there. Are you already holding this stock? Are you considering buying this stock? Are you staying away no matter what? I want to hear about it. Let me know your thesis in the comments below. I appreciate you being here in a major way. Hope you got some value out of this. Hope you got a nice overview of the stock. Thank you so much. Have a great day.